Question 1, scenario-based. Topic: claims and recoveries in reinsurance. Mr. Thompson, an insurance company claims manager, submitted a large claim to their reinsurer under a proportional quota share reinsurance treaty. The reinsurer, however, disputed the claim, citing that the insurer failed to notify them of a policy change that increased the underlying risk. The reinsurance treaty includes a claims cooperation clause that requires the insurer to notify the reinsurer of any material policy changes. What is the most appropriate action Mr. Thompson should take to resolve the dispute? A. Seek immediate arbitration under Kansas insurance law. B. Negotiate a settlement with the reinsurer based on the claim amount. C. Review the claims cooperation clause to ensure compliance and provide the missing notification to the reinsurer. D. Cancel the reinsurance treaty and seek recovery through another reinsurer. Answer: C. Explanation. In Kansas, a claims cooperation clause is a critical component of reinsurance contracts. It requires the ceding insurer to notify the reinsurer of material changes in the risk, which is essential for the reinsurer to adjust their pricing and reserves accordingly. Failure to comply with this clause can lead to disputes, as seen in this case. Mr. Thompson should first ensure compliance by reviewing the clause and providing the necessary notification to the reinsurer. Option quasi arbitration is premature, as disputes are often resolved through compliance and negotiation before escalating to arbitration. Option B, negotiation, may not be valid if the insurer has not met the contractual requirements. Option D, cancelling the treaty, is not a feasible or practical solution without attempting resolution first. Relevant rule: Kansas Insurance Code, KSA 402201, outlines the importance of adhering to contractual obligations in reinsurance agreements. Question 2. Topic: types of reinsurance. Which of the following is a key difference between proportional and non-proportional reinsurance contracts? A. Proportional reinsurance requires the reinsurer to pay losses only after a specified threshold is reached, whereas non-proportional reinsurance shares premiums and losses from the first dollar. B. Proportional reinsurance involves sharing both premiums and losses between the insurer and reinsurer, while non-proportional reinsurance only covers losses above a certain limit. C. Non-proportional reinsurance is only used for catastrophic events, whereas proportional reinsurance applies to all types of risks. D. Non-proportional reinsurance is more commonly used in primary insurance markets, while proportional reinsurance is used exclusively for reinsurance purposes. Answer: B. Explanation. The key distinction between proportional and non-proportional reinsurance is the method of sharing risk and premium. Proportional reinsurance, such as quota share or surplus share, involves the sharing of both premiums and losses between the insurer and the reinsurer from the start. Non-proportional reinsurance, such as excessive loss, provides coverage only when losses exceed a specified threshold, which protects insurers for large unexpected claims. Option is incorrect because it reverses the definitions of the two types of reinsurance. Option C is incorrect, as both types of reinsurance can cover various risks, not just catastrophic events. Option D is incorrect, since both proportional and non-proportional reinsurance are used in reinsurance markets. Relevant guideline: NAIC Reinsurance Practices and Procedures Manual, which outlines the fundamentals of different types of reinsurance. Question 3. Topic: reinsurance contracts. Which of the following clauses in a reinsurance contract best protects the reinsurer from unexpected losses due to changes in the insurer's underwriting policies? A. Loss adjustment expense clause. B. Claims cooperation clause. C. Entire agreement clause. D. Follow the fortunes clause. Answer: B. Explanation. The claims cooperation clause requires the ceding insurer to inform the reinsurer about significant changes in underwriting policies which could impact the reinsurer's exposure. This clause ensures the reinsurer remains aware of any material changes in the risk profile and can adjust their pricing and reserves accordingly. Optional loss adjustment expense clause pertains to covering expenses related to adjusting claims, not underwriting changes. Option C, entire agreement clause, states that the contract contains the complete understanding between parties, but it doesn't specifically address risk changes. Option D, follow the fortunes clause, obligates the reinsurer to follow the decisions of the ceding insurer, but it does not specifically protect against unexpected underwriting changes. Relevant rule: Kansas Department of Insurance Reinsurance Guidelines, which highlight the importance of cooperation and transparency between insurers and reinsurers. Question 4, scenario-based. Topic: Reinsurance risk management. Grace Insurance Company in Kansas has recently increased its exposure to natural disasters by underwriting more policies in flood-prone areas. To mitigate this risk, the company enters into a reinsurance contract. However, 6 months later, the reinsurer refuses to cover a major loss, arguing that Grace Insurance failed to disclose the significant increase in risk. Reinsurance contract includes a material change clause. What should Grace Insurance have done to ensure compliance with the contract? A. Included a loss reserve report in its initial submission to the reinsurer. B. Provided the reinsurer with quarterly updates on risk exposure changes. C. Sent a notice of increased risk exposure only if a catastrophic event occurred. D. Renegotiated the terms of the reinsurance contract after increasing its exposure. Answer: B. Explanation. The material change clause in a reinsurance contract requires the insurer to notify the reinsurer of any significant changes in risk exposure. Regular updates on risk exposure, such as quarterly reports, help maintain transparency and ensure the reinsurer is aware of evolving risks. Option is incorrect because the loss reserve report focuses on financial reserves, not risk exposure. Option C is incorrect because notification should happen proactively, not only after a catastrophic event. Option D is incorrect because renegotiating terms is not a requirement for compliance with the material change clause. Relevant rule: Kansas Insurance Code K.S.A. 40221, which mandates transparency between insurers and reinsurers. Question 5. Topic: Reinsurance in catastrophic events. Which of the following is a key benefit of using catastrophe bonds as part of a reinsurance strategy? A. Catastrophe bonds provide coverage for all types of claims, including non-catastrophic losses. B. Catastrophe bonds allow insurers to transfer risk to capital markets, reducing reliance on traditional reinsurers. C. Catastrophe bonds are only available to government-run insurance programs. D. Catastrophe bonds guarantee full recovery of losses, regardless of the event's severity. Answer: B. Explanation. Catastrophe bonds are a tool that allows insurers to transfer risk to the capital markets, which can reduce their dependence on traditional reinsurance. These bonds are typically triggered by specific catastrophic events, such as hurricanes or earthquakes, and provide additional financial security to insurers. Option is incorrect because catastrophe bonds are designed specifically for catastrophic events. Option C is incorrect because catastrophe bonds are available to both public and private entities. Option D is incorrect because the payout depends on the terms of the bond, not guaranteed full recovery. Relevant guideline: NAIC Reinsurance Practice Guidelines, which explain alternative risk transfer methods. Question 6. Topic: Reinsurance contracts. Which clause in a reinsurance contract obligates the reinsurer to follow the claims decisions made by the original insurer as long as those decisions are made in good faith? A. Claims cooperation clause. B. Material misrepresentation clause. C. Follow the fortunes clause. D. Arbitration clause. Answer: C. Explanation. The follow the fortunes clause requires the reinsurer to accept the claims decisions of the ceding insurer, provided those decisions are made in good faith and are within the scope of the original policy terms. This clause helps ensure that reinsurers cannot refuse to pay claims based on their own assessment of the claim. Option refers to cooperation during claims handling, not decision-making authority. Option B pertains to disclosures during contract formation, not claims handling. Option D relates to dispute resolution, not claim decision obligations. Relevant rule: Kansas Department of Insurance Reinsurance Guidelines, which highlight the significance of good faith in claims handling. Question 7. Topic: Reinsurance regulation. Which regulatory body is responsible for overseeing the solvency of reinsurers operating in Kansas? A. National Association of Insurance Commissioners, NAIC. B. Kansas Reinsurance Advisory Committee. C. Kansas Department of Insurance, AI. D. Federal Insurance Office, FIO. Answer: C. Explanation. The Kansas Department of Insurance, AI, is responsible for regulating insurance companies and reinsurers operating in Kansas, including overseeing their solvency. The department ensures that insurers and reinsurers maintain adequate reserves and comply with Kansas laws. Options Nick provides model laws and guidance but does not directly regulate companies in Kansas. Option B is a fictitious body. Option D, FIO, monitors the national insurance market but does not have direct regulatory authority over state insurers. Relevant law, KSA 40201, which outlines the responsibilities of the Kansas Department of Insurance. Question 8. Topic: Reinsurance risk management. Which of the following is an effective risk diversification strategy for an insurer using reinsurance? A. Purchasing only facultative reinsurance for high-value policies. B. Utilizing a combination of proportional and non-proportional reinsurance treaties. D. Only reinsuring policies with high loss ratios to maximize recoveries. D. Avoiding any reinsurance to maintain full premium income. Answer B. Explanation. An effective risk diversification strategy involves using a mix of proportional and non-proportional reinsurance. This approach allows insurers to manage both frequency and severity risks by spreading potential losses across different layers of coverage. Option is not comprehensive enough to address all risks. Option C is incorrect, as focusing only on high-loss policies increases the insurer's exposure. Option D is incorrect because avoiding reinsurance exposes the insurer to excessive risk. Relevant guideline: NAIC Risk Management Framework, which outlines best practices for risk diversification. Question 9. Topic: Types of reinsurance. Which type of reinsurance is best suited for protecting an insurance company from a large unexpected loss from a single catastrophic event? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Stop loss reinsurance. Answer C. Explanation. Excessive loss reinsurance is designed to protect insurers from large unexpected losses by covering claims above a specified threshold. This is particularly useful for catastrophic events where losses can exceed normal expectations. Options of quota share shares a fixed percentage of premiums and losses. Option B. Surplus share shares premiums and losses above a certain policy limit. Option D. Stop loss covers aggregate losses but may not be as effective for single large losses. Relevant rule: Kansas Reinsurance Law KSA 40221, which discusses different reinsurance arrangements. Question 10. Topic: Reinsurance accounting. Which accounting method is primarily used to report reinsurance recoverables on a reinsurer's financial statements? A. Fair value accounting. B. Accrual accounting. C. Cash basis accounting. D. Statutory accounting principles SAP. Answer D. Explanation. Reinsurers typically use statutory accounting principles SAP to report their financials, including reinsurance recoverables. SAP focuses on solvency and the ability of an insurer to meet its obligations to policyholders. Options of fair value is used for investment reporting, not reinsurance recoverables. Option B. Accrual is part of GOP but not the primary method for statutory reporting. Option C. Cash basis is not suitable for complex insurance transactions. Relevant rule: Kansas insurance regulations, which require insurers to follow SAP guidelines. Question 11. Topic: Reinsurance basics. What is the primary purpose of reinsurance for insurance companies? A. To increase their underwriting capacity and spread risk. B. To eliminate all underwriting risks. C. To maximize profit margins by avoiding claims payments. D. To bypass regulatory compliance requirements. Answer A. Explanation. Reinsurance allows insurance companies to increase their underwriting capacity by transferring a portion of their risk to the reinsurer. This helps them take on more policies while maintaining financial stability. Question 12. Topic: Proportional reinsurance. In a quota share reinsurance agreement, if the ceding company retains 40% of the risk and cedes 60% to the reinsurer, how will a $100,000 loss be split? A. $40,000 retained, $60,000 ceded. B. $50,000 retained, $50,000 ceded. C. $60,000 retained, $40,000 ceded. D. $100,000 ceded. Answer and explanation. Under a quota share agreement, losses are divided in proportion to the retained and ceded percentages. The ceding company retains 40%, $40,000, and the reinsurer takes 60%, $60,000. Question 13. Topic: Reinsurance contract provisions. Which provision in A reinsurance contract specifies the reinsurer's obligation to cover claims even if the original insurer becomes insolvent. A. Insolvency clause. B. Arbitration clause. C. Entire agreement clause. D. Notice of loss clause. Answer A. Explanation. The insolvency clause ensures that the reinsurer remains responsible for its share of claims payments even if the ceding insurer becomes insolvent. Question 14. Topic: Facultative reinsurance. Which of the following best describes facultative reinsurance? A. A reinsurance agreement that covers an entire portfolio of risks. B. Reinsurance purchased on a case-by-case basis for individual risks. C. An automatic treaty that does not require individual risk assessment. D. A proportional reinsurance method with fixed risk-sharing percentages. Answer B. Explanation. Facultative reinsurance is arranged on an individual basis, allowing insurers to choose specific risks to reinsure. Question 15. Topic: Reinsurance types. Which type of reinsurance is used to protect an insurer from cumulative losses over a defined period? A. Stop-loss reinsurance. B. Facultative reinsurance. C. Excessive loss reinsurance. D. Surplus share reinsurance. Answer A. Explanation. Stop-loss reinsurance provides coverage when an insurer's aggregate losses exceed a predetermined threshold. Question 16. Topic: Kansas reinsurance regulation. What is the minimum capital requirement for a reinsurer to operate in Kansas under state law? A. $1 million. B. $5 million. C. $10 million. D. $15 million. Answer B. Explanation. Kansas regulations require a minimum capital of $5 million for reinsurers to ensure financial stability and solvency. Question 17. Topic: Reinsurance recoveries. How are reinsurance recoverables classified on an insurer's financial statements? A. Liabilities. B. Assets. C. Revenue. D. Equity. Answer B. Explanation. Reinsurance recoverables represent amounts due from reinsurers and are classified as assets on the financial statements. Question 18. Topic: Risk transfer requirements. For a reinsurance agreement to qualify as a risk transfer under Kansas law, what must be demonstrated? A. The reinsurer has assumed significant insurance risk and the agreement transfers the potential for loss. B. The agreement is written as a proportional treaty. C. The reinsurer pays all claims within 30 days. D. The agreement includes the follow the settlements clause. Answer A. Explanation. Risk transfer requires the reinsurer to assume significant insurance risk, and there must be a reasonable possibility of a loss to the reinsurer. Question 19. Topic: Reinsurance underwriting. What is the primary responsibility of a reinsurance underwriter? A. To manage the ceding insurer's policyholder claims. B. To assess and price reinsurance risks for acceptance. C. To regulate insurance companies' compliance with state laws. D. To provide legal counsel for reinsurance contracts. Answer B. Explanation. A reinsurance underwriter evaluates and prices risks, ensuring that they align with the reinsurer's risk tolerance and profitability goals. Question 20. Topic: Arbitration clauses. Why are arbitration clauses included in many reinsurance contracts? A. To specify the method of determining premium rates. B. To expedite the resolution of disputes without going to court. C. To outline claims handling procedures. D. To ensure compliance with Kansas Insurance Code. Answer B. Explanation. Arbitration clauses facilitate efficient dispute resolution, avoiding lengthy and costly litigation processes. Question 21. Topic: Kansas insurance law. Under Kansas law, how often must reinsurers submit financial statements to the Kansas Department of Insurance? A. Monthly. B. Quarterly. C. Annually. D. Biannually. Answer C. Explanation. Reinsurers are required to submit annual financial statements to ensure compliance with Kansas regulatory standards. Question 22. Topic: Retention limits. What does the retention limit in a reinsurance agreement specify? The maximum premium an insurer can charge for a policy. B. The portion of a risk retained by the ceding insurer. C. The minimum capital reserves required by the reinsurer. D. The total policy limits for all risks covered. Answer B. Explanation. The retention limit specifies the amount of risk that the ceding insurer retains before the reinsurer's coverage begins. Question 23. Topic: Proportional versus non-proportional reinsurance. Which of the following is a key difference between proportional and non-proportional reinsurance? A. Proportional reinsurance shares losses equally, while non-proportional reinsurance does not involve premiums. B. Proportional reinsurance shares premiums and losses, while non-proportional reinsurance covers losses exceeding a threshold. C. Proportional reinsurance applies only to catastrophic risks, while non-proportional reinsurance applies to all risks. D. Proportional reinsurance is exclusive to facultative agreements. Non-proportional applies to treaties. Answer B. Explanation. Proportional reinsurance involves sharing premiums and losses based on an agreed percentage, while non-proportional reinsurance provides coverage once losses exceed a specified threshold. Question 24. Topic: Non-proportional reinsurance. An insurance company enters into an excessive loss reinsurance agreement with a retention limit of $1 million. If a claim amounts to $1.8 million, how much will the reinsurer be responsible for? A. $800,000. B. $1 million. C. $1.8 million. D. $0. Answer A. Explanation. In an excessive loss reinsurance agreement, the reinsurer covers losses above the retention limit. The ceding insurer retains the first $1 million and the reinsurer pays the remaining $800,000. Question 25. Topic: Facultative reinsurance. Which of the following scenarios is most suitable for facultative reinsurance? A. A life insurer needs ongoing coverage for a large portfolio of policies. B. An insurer seeks coverage for high-value industrial machinery at a single location. C. An insurer wants automatic coverage for all motor vehicle policies issued. D. A reinsurer agrees to cover an entire book of crop insurance policies. Answer B. Explanation. Facultative reinsurance is case-by-case coverage, typically used for large, unusual, or high-risk exposures such as a high-value industrial property. Treaty reinsurance would be more suitable for portfolios or automatic coverage. Question 26. Scenario-based. Topic: Claims and recoveries in reinsurance. Mr. Reynolds, an underwriter at Midwest Mutual Insurance, is handling a claim related to a catastrophic flood event. The company has a stop-loss reinsurance agreement in place with a threshold limit of $10 million in total claims for the year. So far, the insurer has paid $9.5 million in claims, a new claim worth $2 million submitted. What amount will the reinsurer cover under this stop-loss agreement? A. $2 million. B. $1.5 million. C. $500,000. D. $0. Answer B. Explanation. A stop-loss reinsurance agreement covers aggregate losses above a threshold. Since the company has already paid $9.5 million, the reinsurer will cover $1.5 million of the next claim to reach the $10 million threshold. The insurer remains responsible for the first $500,000 of the new claim. Question 27. Topic: Reinsurance accounting. Which of the following best describes how reinsurance recoverables are treated in financial statements under Kansas regulatory guidelines? A. They are recorded as liabilities on the balance sheet. B. They are treated as income on the profit and loss statement. C. They are classified as assets on the balance sheet. D. They are considered equity contributions. Answer C. Explanation. Reinsurance recoverables represent amounts due from reinsurers for claims paid by the ceding insurer. They are classified as assets on the balance sheet, reflecting the insurer's right to recover those funds. Question 28. Topic: Reinsurance regulation in Kansas. Under Kansas law, how often must licensed reinsurers submit risk-based capital (RBC) reports to the Kansas Department of Insurance? A. Annually. B. Quarterly. C. Monthly. D. Biannually. Answer A. Explanation. Kansas regulations require reinsurers to submit annual risk-based capital (RBC) reports to ensure they maintain sufficient capital to cover their obligations. This report assesses the financial health and solvency of the reinsurer. Question 29. Topic: Reinsurance contracts. What is the purpose of the follow the settlements clause in a reinsurance contract? A. To allow the reinsurer to contest the ceding insurer's claims decisions. B. To require the reinsurer to accept the ceding insurer's claims settlements as binding. C. To mandate the reinsurer to handle claims directly with policyholders. D. To allow the reinsurer to set its own underwriting guidelines. Answer. B. Explanation. The follow the settlements clause requires the reinsurer to accept claims settlements made in good faith by the ceding insurer as binding, even if the reinsurer might have handled the claim differently. This clause promotes smooth claims handling and reduces disputes. Question 30. Topic: Risk diversification strategies. Which of the following is a key risk diversification strategy employed by reinsurers to manage their exposure? Concentrating on a single geographic region to reduce variability. B. Avoiding high-risk industries entirely. C. Spreading risk across multiple lines of business and regions. D. Accepting only small value policies to minimize payouts. Answer. C. Explanation. Reinsurers use risk diversification by spreading their risk across different lines of business, geographic areas, and policy types. Its strategy reduces the impact of catastrophic events or industry-specific losses on their portfolio.